So let's go to the adjusting entries. This is as easy as this. We're just going to say as of, let's say, 2/28. Well, let's just call it closing entries. Is going to be closing entries of, as let's say 2/28 closing entries. 2/28 closing entries. So I'm just going to go to the income statement over here. And everything on the income statement needs to be 0. So I'm just going to say this is going to be negative of the one above it. Whatever's in there, I want to do the opposite. And I'm just going to take that whole thing, copy it across. And so now we're just going to do the opposite of every account that's a temporary account, all income statement accounts in other words. Now, it has to be in balance. So where's it going to go? Okay, paso, what is happening here? It's going to go into the owner's equity, noting that this would be the account that would automatically roll over in like a QuickBooks or a 0. If it was a corporation, it would be called retained earnings, noting the name retained earnings, indicating that it's the earnings that the corporation, in that case, has earned, has accumulated, but not given out to the owners in the form of dividends, hence retained. We retained them in the company. So this is going to be the negative sum of all of this, which is going to be basically the net income. So this amount, 1324, you'll recall, was the bottom line of the income statement, hopefully, right? It's the bottom line of the income statement. It's net income. So this is the amount that would be shown on a QuickBooks software, for example, in net income in the equity section, trying to let us know how the income statement is tied out to the balance sheet. Now, remember how this is a problem, because if that was shown on the balance sheet, it could be messy if you have a partnership, for example. If you have a partnership, you have 5 partners, let's say, then it's not enough to just say you have one account that's going to be all equity that represents the owner's share of the assets, as opposed to the third-party liability shares, like the bank, of the assets, for example, because you have to further break it down into which owner. There's 5 of them now. So similarly to having like the accounts payable needing a subledger telling you who we owe that money to by vendor, you're going to need in the equity section a list of all of the partners listing out who we owe the money to, because it's not going to be equal. And this, I just want to point this out, because a lot of people think that a partnership means it's going to be split evenly, or even that a partnership means 2 partners, like a marriage or something. Marriage is a type of partnership, but we're talking about a corporate partnership, so there could be 100 partners, right? There could be, but there might be more than 2 partners. And you don't always need to split the partnership evenly, because you see how restrictive that would be. You can't always have an even partnership, because people are contributing different things into the partnership. That's why you're bringing up a partner. I'm not bringing in a partner that's exactly like me, because I already have someone exactly like me. Like I might have some money and someone else might be smart or something. Then I'm going to put in the capital, and they're going to be the smart person that actually like earns money or something. That means that we should split the revenue in some way that coincides to the contributions of the partnership. And the thing about a partnership is you have a bunch of different ways you could do that. So you might split the partnership up differently, which means that this net income needs to then be allocated to the partnership accounts in that case, which is kind of a problem if the QuickBooks file has net income sitting there as a lump sum, because you want to break it out into the partnership accounts, right? So that becomes kind of an issue. If it was a corporation, it's actually a little bit easier for a corporation, because you break out the different ownership potentials of a corporation by breaking the corporation value into equal chunks. And then some owners can own more of those equal chunks, like owning dollars that all have equivalent value than others. So on the investment side of things, however, remember that if it was a corporation, then the investments would be from the owner. That would be when the company issues the stock, not when you buy the stock on the secondary exchange, but when the company issues the stock, then the owners are giving money to the company investing in the company for the stock. That's going to be equivalent to an investment in our case, or owner investment for a sole proprietorship. And the draws, you will recall, are us, the owner, taking money out of the business. If that we equate that to a corporation, it would be dividends going out of the business to the owners. Noting, however, that dividends, if you're a corporation, are going to be more of a bureaucratic problem, because you can't, like in a partnership, have each owner taking out a different level of dividends from the corporation. It has to be equal, because that's the point of having stocks. They're all the same, and therefore you're going to have some, board meeting and whatnot and management to figure out the dividends. So I'm not going to close out the draws and the investments. We're going to keep those as the lifetime, draws and investments. So I'll just say 0 here and 0 here. And then let's put zeros across the board, noting that all of the other accounts are what we call permanent accounts. Basically, the balance sheet accounts, or at least the assets and liabilities, are permanent as opposed to temporary. This is also a good point to point out the terminology. There often is a problem of these income statement accounts being called temporary, and these two accounts would be temporary as well in a book problem, because they close out periodically when we do the closing process typically. That's different than, say, a clearing account. And a clearing account is going to be something like this undeposited funds, where we put the money into a holding account instead of putting it into the cash account, so that we can then use it to group the money into the checking account in the same way that it will be shown on the bank statement. So that means that this one's going to go up. They both temporary accounts and clearing accounts, therefore, are going to zero out, right? They're being used to go up and then back down to zero. But the clearing account has a specific purpose and isn't really used on like a timing frame, such as the temporary accounts. The temporary accounts go up and then they get zeroed out, but they get zeroed out when the closing process happens. Whereas a clearing account goes up and gets zeroed out, but it gets zeroed out not when the closing process happens necessarily, but rather whenever it served its purpose, right? In this case, whenever we take the money out of it to deposit into the checking account. All right, let's put an underline under this whole dang thing. Underline, home tab, font group, underline. There we go, yo. And let's bring down the balances. So I'm going to say balances need to be brought down. Let's see if we're in balance first. So notice that nothing's happening. Why? Because the income statement is part of equity. It closed out into another equity, which is the owner's equity. And I put the underline in the wrong spot. Get your head in the game. Now you got to fix it. I'm sick of fixing your problems, man. Get it right the first time. Home tab, font group, underline. All right, I'm going to underline it here. All right, I see it now. I see what I did wrong. I'm going to underline the right one this time. All right, and then let's sum this up. Equals the SUM of the prior balance, current activity. All the permanent accounts remain the same. We're just going to copy this across formula-wise. But the income statement accounts, those get zeroed out. So now we have a nice fresh start of zeros in the income statement accounts. Now, when we enter our reversing entries here, it's going to look funny, because we're going to start off with some income statement accounts that are kind of backwards. Meaning, when I reverse like that invoice transaction, I'm going to start with a sales account that will be negative, and a cost of goods sold account that will be a positive number here, but it'll be like a negative expense, right? They'll be backwards, because usually these accounts only go one way. They go up. Like if you're driving your car and you're seeing how far you can go in a day. Even if you drive in a circle and you make a U-turn, the odometer still goes up, right? That's the same with all of these accounts. They go up until we close them out, resetting the odometer, unless something funny happens, like the reversing entries that we're going to be entering next time. So that's going to confuse the bookkeeper a little bit, because they're going to be like, what is going on with these like reversing entries? They make the income statement funny looking. And we're like, that's cool. And so we're going to deal with it. So we might have to say, okay, explain why that happened. But it made the data input easier, right? So we'll kind of explain each of the reversing entries, preparing ourselves for explanations to the bookkeeping department, which is part of our, and the accounting department or whatever, which is part of our job to keep everybody in the loop and on the same, knowing what the other person's doing. Whether you're in the accounting department or the adjusting department, it shouldn't be like, oh, those stupid adjusting people messed up my stuff again. Or in the adjusting department, well, those dang accounting people are mad that I did this or the other thing, right? We try to keep it, each one should respect that the other one is doing a different objective, and we're trying to keep it so each one can do their objective without messing up the other one. It's kind of, that's what I'm thinking. All right. People are going to be mad. I know. You can't make people happy. I know, but we can try to explain it. They're going to get mad at you no matter what you do. Okay. Let's not get defeatist. Let's not get like nihilistic or like, anyway, no need to despair. We'll make it so people understand. Let's put an underline here, home tab, font group, underline, and that looks good.